Hey guys, how's it going? Value Venture Investing here. I'm hoping for a market crash. Okay, now if that really blows your mind, you really need to watch this video. That's the secret that the rich know and that the poor are just simply not aware of whatsoever. Recessions build wealth. There are opportunities. And today I'm going to really show you that to you guys by showing you basically a zero risk scenario, just holding index funds, what you should do versus what people actually do. And then at the end, I'm going to give you some really kind of interesting figures. Stick around for those. But I'm going to just start this by giving you guys some real interesting statistics here, okay? You might have heard this before. It's more dangerous to be out of the market than to be in, right? Even if there's a recession or something like that, it's more dangerous to time the market. We've all heard that before. You know, there's been numerous studies where timing the market just doesn't work. Trading too much doesn't work, right? But these are quite interesting. From 1996 to 2015, so this is a pretty long period of time, we saw the average S&P go up about 8.2% a year. So that's obviously excluding dividends, I'm pretty sure as well. But not a really long period of time, you know, over very, very long periods of time, it's about 10% a year. But the average was 8.2%. This is interesting. If you miss the 10 best trading days of the year, that drops to 4.5% a year. That's like half for 10 days, the 10 best trading days in the year. What about 20? The best 20 trading days in the year. 2.1%. I mean, that's something that maybe you, if you had enough money, you could get in the bank right now. And that's just missing 20 of the best days. So say you were, you know, trying to time the market, you were out of it, whatever. 2.1%. What about 30? 0%. Those are some really sobering numbers, and I wanted to just give those to you guys right now to give you a perspective of where we're at right now. We've seen the yield curve, you know, be shifting a bit. We've seen geopolitical risk. There's always these things that are happening, guys, right? But the idea is that you need to steer the course, long-term investing. Okay, so to give you the perspective on this, this is the SPY. So it's the S&P 500 ETF. It tracks the S&P 500. It's an ETF. And the fees are just extremely low, very low. So this is what I recommend to anybody. If you want to be in the US markets, I think the S&P 500 is one of the best ones because it's something like over 80% exposure to the US stocks. So that's what I suggest for somebody who isn't too versed in investing, as well as those who really know what they're doing as well, because generally speaking, we know we can't beat the market. Even though a lot of people try, and I have different things in my portfolio that they've done very well too. So let's say at the peak, your portfolio, for argument's sake, is $100,000. So the peak before the recession, I got a little bit chart here, was on November of 2007, roughly. That was the highest point that it was at before it began to fall. Okay, so let's take a look at that right now on the chart. You can see that the peak was it was somewhere around $155. And then we saw it, you know, drop down a little bit here, bounce a bit, you know, and then fall the rest of the way. But the key is you're going to be in at the peak with that $100,000 if you implement the strategy that I'm trying to tell you guys. The strategy is you do not sell that, right? So this is long-term investing. You don't need that money for anything else. So the argument is you're going to have that money in at the peak, right? Today, that's worth $177,000. That's just leaving it in for roughly 10, 11 years and doing nothing, okay? What gets interesting is the opportunity. Like I said, this is what the rich know and that the poor do not know, is that there's always these massive opportunities in recessions. So say you don't have a lot of money, say you have $10,000, say you save that up, like I recommend to you guys building your cash balances right now for opportunities like this. And say you don't even hit it at the bottom. Like, so this is a graphical representation here. You ran at the peak, you didn't sell, it drops. You never know where the bottom's gonna be. You can't time it and be like, this could be the bottom, this could be the bottom. So I made a pretty, I don't know, reasonable assumption that on October of 2008, you're down about 43% at that time. That you're like, okay, this is good enough, I'm gonna buy it. I only have $10,000 more, right? So I'm gonna invest here at roughly, October 2008. Today, that's going to be worth $32,000. Just that $10,000, right? That's today. So on your first bit, you made $77,000. Pretty damn good for 10 years. on your additional 10,000, you've made another $22,000. So you've made approximately $100,000 with zero risk. I mean, there's always risk in the market, but this is called systematic risk. This is the risk of the market as a whole, right? You made $100,000, nearly 90%. And what's the majority of people doing here? They're freaking out. What are the majority of people doing here? They're freaking out. They're freaking out. Let's take a look at the chart here again. You know, it's just started skyrocketing down just tremendously. But I mean, here people are just losing their minds. You know, even if you are a long-term investor, you're going to be a little bit scared, right? You're going to be a little bit scared. But if you know these facts that the market always recovers over long periods of time, you should not even be. It shouldn't even bother you. You should be happy about it, right? I mean, it's a little easier said than done. But when you look at the past, I could do this for many different time periods in history. Over long periods of time, you're going to end up being much better, especially if you can buy in. So what is it that most people do, right? So the situation is a lot different for most people. Even people that are very versed in the market end up doing something like this, right? So like this is the market that we were talking about, right? It's going up, 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 up. Here's the peak. The peak was on November 2007, right? So people have 100K invested here, right? So the market starts to drop. People start freaking out. Emotions drive people's trading. They're very powerful. It starts going down, 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 and eventually hits its trough here, right? So most people, you know, they don't have that tough of a stomach. Maybe somewhere around down here, we'll make it the argument that it's the same date, around October of 08. We were down, what did I say, 43%? Not 46, 43%, right? So 43% off 100K, you're roughly 55K is what your 100K is worth. And then people, they just generally just stay out of the market, right? They're just done. It's gonna hit its trough down here somewhere, and it's gonna start recovering. But generally people, you know, when they're that spooked, they've lost that much money, they're not gonna get back involved again. In my experience, probably when it hits the level that it was here again, that's when people are gonna get back in the market, right? When it hit the level that was, you know, approximate to the peak. So here they might buy back in, say, to that ETF that I'm talking about, the market as a whole, with 55K, right? Not the worst thing in the world to do, because of course the market just kept going up and up and up and up, right? And today, that'd be worth about $115,000, right? But let's compare that to this strategy where you actually held on, you bought a little bit more. What is this? 77,000 to 22,000? It's roughly 209K. So you're almost $100,000 better off. You've lost $100,000 because of emotion. That's simply put, that's the simplest way to look at it. It was emotion that cost you almost 100K in like 10, 11 years, $100,000. And all you needed to add here was $10,000. Now I'm making some assumptions here, right? Like this could change. These recessions are different, right? You know, you could be buying higher, you know, lower, where nothing's perfect. But I mean, you just look at this one example, and this gives you some perspective on what you should be doing. 100K for emotion is essentially, you know, what it is here. And this is, like I said, with only with only $10,000 to add. If you had a 100K in there, can you imagine what it would be? Or, you know, even something just slightly more than $10,000. And you also got to keep in mind that this gain on the S&P 500, as well as this $10,000 that you add to the S&P 500 through this ETF, that's without dividends too, right? The S&P 500 is what, like 1.5% dividends as well. So it's just incredible, guys. So that's like a zero risk approach to the market as a whole. But I thought I would just show you, just for the fun of it, a couple other ones here. So we have some other companies here. We have Apple, we have Amazon, and we have Netflix. Okay, as you can probably tell, yes, I've cherry picked them, but I'm going to use this $10,000. So say instead you just wanted to stay in the market with your $100,000 and put 10K in one of these tech stocks that are just beaten down, which could be an opportunity if we do see another recession, right? So I had these down on my iPad here. Your original $10,000 investment in Apple plus the $100,000 here is roughly, you know, these are all kind of rough numbers, $340,000. So that's versus, we'll put what we had here, 209,000. So you can look at your different risk profiles there, but obviously significantly better in Apple. Amazon, it's even better, 504 or 540,000 K. That's crazy, crazy opportunities. You're not going to see that kind of opportunity right now unless you see the market pull back. And this is one that I actually have a story behind. Netflix. I had a market order in Netflix for, actually it was $10,000. I think it was back in 2013 or something, and I just kicked myself. I kicked myself for canceling it and not holding. But Netflix, almost $1.4 million holding your 100K and adding $10,000 to Netflix. So it's just, the numbers are there, guys. I wanted to do this video to give you some perspective. Don't freak out. If you're a long-term investor, you need to stay the course. Courage is rewarded with money, right? If you lose all composure, you freak out. That's what the majority of people do, and that's why the majority of people lose money, right? But there's always considerations. I'm not trying to give you guys financial advice, tell you exactly what you should do. Every situation is different, right? You might need to retire. You never know. You might not be able to wait out 10 years or something like that. But if you're young enough, and like I always suggest, the money that's in the market you don't need. That's investment, right? You should always have that money sitting there and never touch it. You should, it shouldn't be something that you need to live, right? So that's obviously one of the biggest components of this, because these bear markets could go on for longer periods of time as well. So I hope you guys found that informative. I put the numbers together because I just wanted to give myself some perspective, because even I, of course, am susceptible to these emotions. I'm like, man, what's going on in the market? What's going to happen? But if you look at the numbers, just stay the course, guys. Just stay the course. All right, so that's going to be it for today, guys, and I'll see you in the next one.